Hello everyone and welcome. Being able to read financial statements is an essential skill for any investor. In this video we're going to explain how to do it, and we'll be using the Tesla financial statements as an example. Let's get started. At the Personal Finance Institute, our mission is to bring financial literacy to you, so that you can plan your financial future. If you are finding our content useful, informative, and you'd like to see more, please do like, share, and subscribe. Companies produce an annual report including financial statements on a yearly basis. However, some companies will produce half-yearly, or even quarterly reports, depending on relevant rules in place. This report is intended to provide stakeholders, including investors, with information regarding the position, performance, and prospects of the company. There are some nuances in financial statements, with differing accounting requirements in different regions, and differing ways of presenting the information depending on the industry. However, most financial statements follow a broadly consistent format, and we'll be working our way through the 2019 Tesla financial accounts as an example. We'll also point out where UK and US terminology differs as we go along. In order to find the financial statements, you can go straight to the company website, where you'll normally find all reports and presentations in the Investor Relations section. This is where you'll be able to get the full accounts. However, you can also find financial account information, summarized nicely and going back multiple years, on many sites such as Yahoo Finance, Morningstar, and others. In the report you'll find a lot more information than just the primary financial statements, and this further information is critical to understanding the accounts fully. For example, details of what the business does, management's commentary to the performance of the business, management's expectations for the future, and what management perceive to be the key risks facing the company, will all be included here. This is important information in order to contextualize the primary financial statements, and prospective investors should certainly read this. It's also worth noting that this information is not audited to the same extent that the primary financial statements are, and it is always good to be skeptical of management's expectations for future performance. The primary financial statements are comprised of the following elements: the balance sheet, the statement of operations and comprehensive income, the statement of equity, the cash flow statement, and the notes to the financial statements. We'll be taking a look at each of these in turn. The balance sheet, known as the Statement of Financial Position in the UK, shows the financial position of the company at a point in time. The balance sheet is comprised of assets, liabilities, and equity. An asset is a resource that will provide future economic benefit to the entity, whilst a liability is an obligation that the company must meet to provide economic benefits to others. Equity is the difference between assets and liabilities and, in theory, represents the net economic assets owned by the company. This gives rise to the accounting equation, assets equals liabilities plus equity, which can be seen on the balance sheet where the total assets, and total liabilities and equity, show the same total. Equity is made up primarily of any capital which has been injected, plus any accumulated profits and losses from previous periods. In group financial statements, such as the ones we are looking at, you may also see the heading, Non-Controlling Interest, on the consolidated balance sheet. This represents the equity that is under the control of the group, but not under the ownership of the ultimate parent company. This is therefore important to understand as an investor when looking at investments in groups. This is a little complex, and we'll release a further video exploring the difference between company and consolidated financial statements another time. The balance sheet therefore should provide information as to the financial stability of the company. Ordinarily, assets and liabilities will be split into current and non-current, with current assets and liabilities defined as those which will fall due within the next 12 months. By looking at the net current assets, as well as the cash balance, we can gain some idea as to the short-term financial position of the company, referred to as liquidity position. This refers to the company's ability to meet upcoming liabilities as they fall due. The statement of operations, sometimes called the income statement, the statement of financial performance, or the P&L, shows all of the revenue and expenses incurred by the company in the period in question. This statement should therefore provide information as to the ability of the entity to generate revenue and earnings over time. At the top of this will be revenue earned, followed by cost of sales, which refers to the direct cost associated with each piece of revenue, before overheads and other costs which are not directly affected by a change in the amount of revenue earned. For example, with Tesla, revenue earned will relate primarily to cars sold, and cost of sales will relate to the costs directly attributable to each car, such as raw material costs. The difference between these gives gross profit, and then further costs are deducted before arriving at the operating profit. This is profit earned by the core operating assets of the business, and is of particular interest to debt investors, whose return is derived before interest and tax deductions. After this, further costs incurred that do not relate to the core operations of the business, such as costs associated with financing, other miscellaneous income/expenses, and tax are all deducted before arriving at net income. Net income is the residual amount earned by the equity holders of the group. Similarly to the balance sheet, the amount relating to the non-controlling interest is then stripped out. For listed companies, basic and diluted earnings per share, or EPS, is then shown below net income, indicating the net income earned per share issued. This is relevant for investors to compare against the current share price. We will also upload a further video explaining the difference between basic and diluted EPS. The statement of operations is followed by the statement of other comprehensive income, which relates to other income and expenses which are disclosed separately to the main P&L under accounting rules. This is primarily because they do not relate to the underlying performance of the operating assets. For example, foreign exchange losses, and revaluation of some assets which are not part of the business's core operations are disclosed here. The statement of equity shows a reconciliation of each element of equity, from period to period. This allows investors to see what has been driving changes in the equity of the company. For example, whether or not changes are organic, and therefore relate to earnings generated by the business, or whether or not changes instead relate to further issuances of capital external to the business. The statement of cash flows is of major importance to investors, because it shows how cash is moving in and out of the business. Whereas net income in the statement of operations is subject to a range of accounting judgments and estimates, cash flow provides an objective view as to whether the company is generating cash through its operations. This is why it is of interest to investors. Cash flow statements can be presented in one of two ways. The direct method, or the indirect method, with the indirect method being the most common. The objective of both of these is to reconcile the opening and closing cash balance. The direct method attributes all movements in cash to relevant outflows and inflows, and in doing so reconciles the opening and closing cash balances. The indirect method, as shown in the Tesla financial statements, first takes the net profit or loss figure from the P&L, and then adjusts this by removing any non-cash income and expenses which feed into the P&L, for example, depreciation and amortization. After these deductions, the cash generated by the operations of the business is calculated, and following this any cash movements which do not relate to changes in the P&L are deducted. These are split between investing cash flows and financing cash flows. Investing cash flows refer to cash inflows and outflows associated with capital expenditure on core operating assets of the business. For example, purchases and sales of property, plant and equipment. This provides investors with information regarding capital expenditure incurred. Financing cash flows relate to cash inflows and outflows that are unrelated to the core operating assets of the business, and instead are related to the financing of the business. For example, cash associated with capital issuances, loans from financial institutions, etc. Overall, this should allow investors to determine how the business is managing its cash level, and whether or not the core operations of the business are generating cash flow. After this, you'll find the notes to the financial statements. These are additional accompanying pieces of information relating to each of the account balances, management's accounting policies, and further information with respect to risk management in the company. Normally you might be able to find a contents page to guide you through, or sometimes references in the balance sheet, P&L, and so on. However, in the Tesla financial statements, they haven't been so kind as to provide this. As an example, this is Note 12, Debt, which contains information about all of the debt financing the company had as of the 31st of December 2019. This may be useful for investors as it shows the maturity of debt financing in place, and therefore it gives some indication of how stable the funding sources are. It also provides information to debt investors as to the other sources of financing. In this case, we can see that the vast majority of the debt Tesla had as of the 31st of December 2019 was non-current, which may give investors some comfort that there isn't a significant refinancing risk in the short term. This is just one example of the information contained in the notes, and we would encourage new investors to spend some time reading through each of the notes in order to gain a full view of the financial statements as a whole. That's all for today, everyone. This video was brought to you by the Personal Finance Institute. Please do remember to like, share, and subscribe, and please do post any questions you have below and we'll be happy to answer them.